The bond market is flashing a warning. And the scariest part? It's eerily silent. Why does this matter? Because when the market goes quiet like this, it's usually the calm before the storm. You're about to see why the 10-year yield is crucial to everything you thought you knew about the economy. This isn't just a market moment. It could change everything. Now let's talk about what's happening behind the scenes. The bond market's silence isn't an accident. This is part of a larger pattern, one that's been building for weeks. The 10-year yield is stuck in its tightest range in 30 years, and no one's talking about it. But here's the question. Why is this happening now? And more importantly, what does it mean for the stock market? Because if history is any guide, this tight range could be setting the stage for something massive. So what's coming next? Keep watching. The answer might shock you. Here's the first bombshell. When bond yields enter tight ranges like this, they don't stay there for long. And what we're seeing now could signal a major shift. Look at this chart. The 10-year yield has barely moved, and yet it's sitting on the edge of a massive breakout. What's the most likely outcome? A spike in yields. We're talking 4.4%, maybe even 4.5%. Now, imagine what happens when that hits the market. The stock market? It will be rattled. And here's the kicker. This spike could be triggered by something completely unexpected, a shift in leadership at the Fed. What does that mean for you? The stakes have never been higher. As the pressure builds, things are about to get even more intense. Remember, the bond market and the stock market don't exist in isolation. A sudden spike in bond yields will ripple across everything, including the equity markets. In fact, this situation is eerily similar to what happened during past market crashes. Tight ranges in yields have preceded big market moves before, and those moves were never gentle. So why are we ignoring the signs? The truth is, we've normalized this volatility. It's almost expected now. But the real question is, how much longer can we keep pretending everything's fine? The answer might surprise you. Now let's talk about the deeper problem. The contradiction. On one hand, we're being told that the Fed is easing, that rates are set to fall. On the other, the bond market is sending us a completely different message. Take a look at this. As the Fed hints at rate cuts, we're seeing yields stay stubbornly high. The market? It's not buying it. This disconnect is huge. It means investors aren't confident that the Fed's plan will actually play out. If yields continue to climb, expect the stock market to take a dive. And here's the kicker. All of this could lead to a much bigger financial crisis. It's not a matter of if, but when. And that's where the real danger lies. Now things are starting to escalate fast. In the past 48 hours, we've seen a flurry of events that have pushed the market to the edge. First, a breakdown in the S&P trend line, a subtle shift, but enough to send warning signals. Then we had that brief rally from Taiwan Semi's earnings, followed by a sudden reversal. The market couldn't hold its gains. That's not a good sign. And if that wasn't enough, look at silver's chart, a sudden drop followed by a quick bounce. It's the kind of volatile movement that signals instability. So what happens if this trend continues? If these small cracks keep appearing, the market could be headed for a bigger collapse. And when it happens, it might be too late to react. Now, let's bring this closer to home. What does all of this mean for you? The volatility in the markets isn't just a headline. It's impacting real people. Investors are feeling the pressure. Everyday traders are watching their portfolios shrink as uncertainty takes hold. And if you're relying on these markets to grow your wealth, things are about to get a lot harder. Imagine seeing your investments drop just because of an unexpected spike in bond yields. It's not just numbers on a screen. It's your financial future. If you've been feeling the strain, you're not alone. Let me know in the comments if this situation feels all too familiar, because if this pattern continues, we're all going to be in for a rough ride. Now let's take a step back and look at the bigger picture. What's driving all of this? The truth is, it's not just about the bond yields or the stock market. It's about the system itself. The forces that shape everything behind the scenes. Think about it. The Fed's independence is under threat, and that could cause long-term rates to rise even higher. The market is starting to reflect this tension, and it's going to affect the global economy. But there's more. We're also seeing huge pressures from foreign investors. If they demand higher returns on U.S. debt, the market will have no choice but to react. This isn't just a market correction, and it's a systemic issue, and that's the part most people are missing. It's time we recognize that the rules are changing, and we might be too late to stop it. So what comes next? There are two possible paths forward. The first is a sharp market correction, where the bond market's warning signals trigger a cascade effect across the equity markets. We could see the S&P drop hundreds of points, and yields could climb higher than we've seen in years. On the other hand, the Fed could find a way to stabilize things, but with so much uncertainty in the air, that seems less likely. Right now, we're at a crossroads. No one can say for sure which way this will go, but the pressure is mounting. And here's the thing. As these events unfold, we're getting closer to a tipping point. The next big move could already be in motion, and the question is, are you ready? Here's the bottom line. The bond market's silence is a warning, and it's telling us that everything could shift in an instant. This isn't just another market dip. This is a reset, and it's coming faster than most realize. The tension in the system is building, and the next move could change everything. One thing is certain, the markets are on edge, and it's only a matter of time before we see which way it breaks. So what will happen next? Only time will tell. But if you want to stay ahead of the curve, hit that follow button for continued analysis, because trust me, we're just getting started.